Toastmaster and Toastmasters. When it comes to stock investing, there's a lot of really bad advice out there, and much of it is trite. One of the worst pieces of advice is you can't go broke by taking a profit. While it's technically true that you can't go broke or go bankrupt by locking in a profit, it's very bad advice because in the long term, it leads to lower returns. It's very dangerous to follow. It's known as the disposition effect by behavioral economics, and it's been shown over the long term to lower your returns, sometimes drastically. So you're all familiar with the bell curve, right? It looks kind of like this, where most things are clustered in the middle and they're very close to average, and there's very little in the outline. If stocks were distributed normally over the long term, and a stock that had performed well for a while went back to the average and started having lower returns, then it might be a good thing to sell a stock once you've had some profit on it. And to keep a stock that had been performing poorly, because it would then return to the average, because it would have above average returns. But that's not how it works. It was a report by Shankar Vedantam for NPR. It was called Put Away the Bell Curve Because Most of Us Aren't Average. It was research done about people in academia, politics, sports, and entertainment. And the results look like this. There's a bell curve in the background, and in the front, you can see the data of how people performed. And actually, about over half of the people, about 65% of the people, performed below average. And then there was a large group of people who performed much better than average, and they raised the average up. So the performance in people in industry does not follow a bell curve, and the performance of stocks over time don't either. Over the past 10 years, 63% of S&P 500 companies have underperformed. And there's a large group of significant outperformers whose returns are well above average. So compared with the bell curve in the background, the data is a mess, and that's what it should be. That's the way stocks return. There's really fat tails on both sides. So what do you do? How do you choose winning stocks? If we all knew the answer to that question, we would be Warren Buffett. And as Warren Buffett likes to say, he wishes he had never sold a stock once he did one. So there's three things you can do. First is to not buy or sell a stock based on price alone. You have to look at the fundamentals. A lot of people have stood by while Apple Computer has risen and risen and risen again. And the reason it is the best performing stock in the S&P over the last 10 years is because the company continues to perform well. And whether it will continue to rise or not depends on how the business performs. It's not reflective on the past performance of the stock. As they always say, past performance is no guarantee of future returns, but it is indicative of how well the company has tended to perform. Number two, you don't have to swing for the fences. You do not have to pick some up-and-coming new company that's going to revolutionize its industry. You just have to pick a solid company that has been outperforming in its industry compared to its competitors. For example, among the S&P 500's very best performers over the last decade are companies like Nike and Caterpillar. They're very older companies, they're in very kind of normal industries, they just perform better than their peers, and they've consistently done so, and there's no reason to abandon them just because the price has gone up, because they're very likely to continue to do so in the future. The third thing is there's no silver bullet. If you Many people like dividends, but if you look over the past 10 years, of the 10 best performing companies the last 10 years, we looked at them 10 years ago, only 5 of them had a dividend. But of the 10 worst performing companies, 9 of them had a dividend. So dividends alone won't get you a good return. Focusing on one industry is likewise not going to give you better returns, because of the stocks that are in the top and the bottom areas of returns, you'll find companies in almost any industry. So what do you do? Basically, while it seems like there's no easy answers, it comes down to 2 answers. You can either give up trying to find the winning stocks and just go with a low-priced index fund, and you'll get an average return, which is perfectly acceptable. It's very low work, and you don't have to worry about how your portfolio is doing. And the other thing is you can stop relying on trite and simplistic stock market sayings and get your hands dirty by researching the fundamentals of the stock that you're investing in. And then you buy and hold them unless the fundamentals change, and your portfolio may amaze you.